You know that feeling, right? You've finally finished your taxes, maybe overpaid a bit, and then great news, a refund's coming your way. Feels good. But then that little question pops up. Hold on. Is this refund actually taxable income? It seems straightforward, but it really isn't always. Today, we're doing a deep dive into something called the tax benefit rule, sometimes known as the tax benefit doctrine. Basically, it's a rule designed to make sure you don't get, well, a double tax break on the same funds. We'll focus on state and local tax refunds specifically. We want to figure out exactly when these refunds are taxable and, crucially, why. And here's the thing many people miss. It's not just about getting the money back. It hinges on whether you got a tax benefit from the original deduction. That's the real core of it. Before we dive deeper, a quick reminder that this deep dive is based on material from Farhat lectures. All content, examples, and explanations discussed here are derived from the comprehensive accounting resources at farhatlectures.com. Whether you're an accounting student, CPA candidate, or professional, visit the website for additional practice questions, video lectures, and detailed support to reinforce today's topic. Special thanks to Professor Farhat for providing this valuable material. Okay, with that foundation, let's really get into this tax benefit rule. So the main issue here often seems to be about timing, right? Different tax years involved.
Exactly. Think about it this way. You file your year one taxes, usually sometime in year two. If you pay too much state or local tax in year one, you might not see that refund check until well into year two.
Right.
So say you get a $3,000 refund in year two, but it's for taxes paid back in year one. The big question is, does that $3,000 count as taxable income on your year two return? It kind of feels like getting taxed on your own money coming back.
Yeah, that's exactly where the confusion hits. Is it the whole refund? Just part of it? Or none of it? I mean, like you said, it's money you overpaid, not really new earnings.
Well, what's really interesting is that the answer completely depends on what you did on your year one tax return.
Yeah.
It's not just about receiving the refund itself. It's all about whether you got a prior tax benefit from the money that was refunded. The rule is pretty clear. If you itemized your deductions in year one, listed things like state taxes instead of taking the standard deduction, and you actually benefited from deducting the specific amount that was later refunded, then yeah, that refund is generally taxable in year two.
Okay, so let me make sure I'm getting this. It's not just getting the check. It's whether I benefited from deducting that specific money in the first place. And what if I just took the standard deduction? Like most people do these days.
That's precisely it. If you took the standard deduction in year one, meaning you didn't itemize, you didn't specifically deduct those state and local taxes, then any refund you get in year two is absolutely not taxable.
Okay.
Why? Because you never got a tax break for it in year one. There's no benefit for the IRS to sort of claw back, you could say. It's basically just correcting an overpayment you never deducted.
Gotcha. So that distinction itemizing versus standard deduction is absolutely critical here. Taking the standard deduction simplifies things a lot and clearly avoids this issue with refunds. But for people who do itemize, maybe because they have high state taxes or mortgage interest, this rule becomes really important. And if the refund is taxable, I'm guessing it goes on Schedule 1 of the 1040 under other income.
Spot on. It goes right there. It's the tax system's way of saying, hey, you got a deduction benefit back then, now you got the money back, so we need to balance things out. But this brings up another really important point. What does benefit actually mean here? And how much of the refund is taxable? Is it always the full amount?
Yeah, that's the next logical question. How do you measure that benefit? Because it doesn't sound like it's simply dollar for dollar with the refund amount itself.
No, it's not. Benefit in this context means your total itemized deductions were actually more than the standard deduction you could have taken for your filing status that year. And because they were higher, you chose to itemize to lower your tax bill. That's the benefit. The choice to itemize gave you a larger deduction. But, and this is the key limitation, the part that often trips people up, the amount of the refund you have to include in your income is limited. It's limited to the excess of the itemized deductions you took over the standard deduction amount available to you that year.
Excess over the standard deduction.
All right, think of it like this. You only pay tax on the actual extra deduction you got because you itemized, compared to just taking the standard amount. So if itemizing gave you a $15,000 deduction, but your standard deduction would have been $14,000 anyway, your real tax benefit from itemizing was only $1,000, not the full $15,000. That $1,000 difference is the benefit the rule cares about.
Okay, wow. That is really crucial to understand. It's not the whole refund, necessarily. It's capped by the actual benefit you received. This definitely needs an example to make it crystal clear. Can we run through some numbers, maybe with, let's call him Josh?
Absolutely. A concrete example always helps. Let's look at Josh.
Perfect. So let's say in year one, Josh itemized his deductions, carefully listed everything out. He had, say, $8,700 in state and local income taxes, plus maybe $1,920 in charitable donations and $4,300 in investment interest expense. Add that all up. $8,700 plus $1,920 plus $4,300. That's $14,920 in total itemized deductions for Josh in year one.
Okay, $14,920 itemized. Got it.
Now, in year two, Josh gets a letter from the state. Good news. A $3,000 tax refund is coming his way. And this $3,000 refund is directly related to that $8,700 state tax deduction he took in year one. One more critical piece. Let's say Josh's standard deduction amount for year one, based on his filing status, was $14,000.
Right. Standard deduction, $14,000. Itemized, $14,920. Refund, $3,000.
Exactly. So now the question. What does Josh do with that $3,000 refund in year two? Is all of it taxable income? Or just some? Or none?
Okay, this scenario fits the tax benefit rule perfectly. Let's break down Josh's situation step by step. In year one, Josh looked at his options. Standard deduction, $14,000. His itemized deductions, $14,920. He chose to itemize because $14,920, it's obviously more than $14,000. It gave him a bigger deduction.
Makes sense.
Now, the crucial part, what was the actual tax benefit he got from choosing to itemize? How much extra deduction did he get compared to the standard? What's the difference? $14,920 minus $14,000. That equals $920.
There's $920. So even though his itemized total was almost $15,000, the extra benefit compared to the standard was less than $1,000.
Exactly. He would have gotten a $14,000 deduction anyway with the standard. Itemizing only gave him additional $920 deduction.
Okay, so how does that connect to the $3,000 refund?
Here's the punchline. Even though Josh received a $3,000 refund, the amount of that refund that is taxable in year two is limited to the tax benefit he received in year one, which we just calculated as $920.
Wow, so only $920 of the $3,000 refund is actually taxable for Josh, not the full $3,000.
Correct. Only $920 is a perfect illustration of that principle. Taxable to the extent of the prior tax benefit. He only benefited by $920 in year one from that state tax deduction relative to the standard deduction, so only $920 of the refund is included in his income in year two. And just to drive the point home, let's imagine slightly different numbers. What if Josh's itemized deductions in year one had been, say, $18,000 instead?
Okay, $18,000 standard, still $14,000.
In that case, his benefit from itemizing would have been $18,000 minus $14,000, which is $4,000.
Right, a $4,000 benefit.
Now, if he gets that same $3,000 state tax refund,
since the benefit, $4,000, is more than the refund, $3,000.
Exactly. In that case, the full $3,000 refund would be taxable because the benefit he received, $4,000, exceeds the amount refunded, $3,000. The taxable amount is the lesser of the refund or the prior benefit.
That makes perfect sense now. It really clarifies how the rule works to prevent that sort of double dipping. It's not trying to penalize you for getting a refund. It's just ensuring fairness, making sure you don't get a deduction for money you eventually got back, unless you truly benefited beyond the standard deduction level in the first place. It kind of levels the playing field across the tax years. Feels logical, actually.
And stepping back to look at the bigger picture, this rule, this concept, it isn't just for state and local tax refunds.
Oh,
Yeah.
Where else does it apply?
Well, the same logic applies to other itemized deductions you might take. Think about medical expenses. Let's say you had a very expensive medical procedure one year, you itemized, and you took a significant medical expense deduction. Then, maybe the next year, your insurance company reviews the claim and realizes they should have covered more, so they send you a reimbursement, a refund essentially, for those medical costs.
I see where this is going.
That reimbursement you receive later would also likely be taxable income in the year you receive it. But again, only to the extent you actually received a tax benefit from deducting those medical expenses in the first place, considering the thresholds and limitations for medical deductions as well.
So the underlying principle is consistent. If you got a tax break through an itemized deduction and then you get money back related to that deducted expense, that money you get back might be taxable but capped at the actual tax benefit you originally got.
Precisely. It puts the responsibility on the taxpayer, on you, to understand how your past deductions might affect the tax treatment of future refunds or reimbursements.
And practically speaking, how does this usually work? Does the government tell you if it's taxable?
Well, for state and local tax refunds, the state or local government will typically send you a form, Form 1099-G.
Right, I've seen those.
That form just reports the amount of the refund they issued to you. It's important information. But and this is a common misunderstanding, the 1099-G itself doesn't say whether that amount is taxable for you.
So it's just informational.
Exactly. It's your job, or your tax preparer's job, to look back at your prior year's return, the years that lax was paid, and figure out if you itemized, and if so, calculate that benefit amount we discussed. Only then can you determine how much, if any, of the refund reported on the 1099-G needs to be included in your income. Don't just assume the full amount is taxable.
Okay, let's wrap this up with the key takeaway then. The main thing to remember about state or local tax refunds is that whether they're taxable or not really comes down to two things from the year you paid the tax. Did you itemize your deductions? And if you did you actually get a tax benefit from that deduction? Meaning, did your itemized total exceed your standard deduction?
That's the heart of it. It's not just getting the refund check. It's the prior deduction and the benefit derived from it.
So, the next time you get a tax refund, maybe pause for a second. It's not just free money landing in your account. It's a chance to think about this interesting interplay between deductions, benefits, and your taxable income across different years. And it really makes you wonder, doesn't it? What other seemingly simple financial things, maybe getting a rebate or a reimbursement, might have these kinds of hidden tax consequences you haven't thought about? Understanding specific rules like this tax benefit rule, well, it can lead to some real aha moments about your own finances. Keep digging, keep asking questions. We'll catch you on the next deep dive.